Welcome to On Investors' Minds. I'm Kerry Craig, a global market strategist here at JP Morgan Asset Management. Thank you for giving us a few minutes of your time to hear about what's on investors' minds and how that fits in with our current views on asset allocation. Now today, I'm very pleased to be joined by Arjun Vij. Arjun is a portfolio manager in our Global Aggregate Strategies team, and he manages the JP Morgan Global Bond Fund. He is also responsible for managing multi-sector bond portfolios for institutional clients across the APAC region. Arjun joins me today here in Sydney on a tour talking to clients. Great to have you back in Australia, Arjun.
Thanks for having me. This is the weather's great, so much better than Melbourne and Auckland, so I'm just glad to be here.
Beautiful day here in Sydney, and I should mention today is the 23rd of July when we're recording this, so a week out from the next Fed meeting, and lots to talk about when it comes to the world of fixed income and obviously the latest views coming out of our GFIC team. Let's start broad. You recently published the latest quarterly update from our GFIC side. Pretty positive outlook when it came to the economy, and your team actually raised the expectations for above trend growth for this year. Now, from the Market Insights team, we would agree that there is definitely a tailwind to economic activity that's keeping these recession risks low. But that resilient economy view is very consensus. And obviously we always start to think about how consensus something becomes. What are the risk case that you're thinking about that sort of catches the market offside when it comes to that market outlook?
Yeah, I mean, I like to tie what's happening on the economic side directly to markets. And when I think about the risks to the market specifically, I think it's that earnings expectations in the US are pretty high. And if earnings come out materially lower than earning expectations, which we're not seeing just yet, that's obviously one big risk. The second big risk is emanating out of the oil crisis in the Middle East. It's really evident that the price of, our own medium-term view is that any price movement in oil beyond 100 is unlikely to sustain. But the risk case there is troops on the ground and a material escalation which results in the price of oil being above 100 for a prolonged period of time. I'd say those are two scenarios where we feel, a couple of scenarios where you'd call into question the positive growth narrative. But, just because something is consensus doesn't mean it's wrong. And in this environment, I still feel, because of a couple of reasons. One, our base case is that the price of oil sits between 70 and 90 for the majority of time over the course of the rest of the year. That, in my mind, is a tailwind, given the peak was $115 in oil earlier the year. Second, we think the AI capex cycle, while it may not be accelerating in terms of business investment, it's definitely broadening out, and that continues and supports growth and makes it hard for us to get into a recession scenario. And then the third thing is to do with the US consumer. Despite inflation remaining elevated at around 2.5–3%, because of the wealth effect, and particularly the wealth effect affecting the upper part of the K, or the higher quartile sort of earner, because stock markets have done well and 401ks are invested in the stock market, we continue to feel that as long as stock markets remain elevated and we don't see a big sell-off, consumer spending should continue. And so now we highlighted the risks earlier, but in terms of growth, I think the tailwind from the consumer, from a broadening out of the capex cycle beyond AI, as well as the worst of the energy crisis behind us, give us conviction that growth will continue to be around 2%. And again, just because something's consensus doesn't mean it's wrong. And so I think you still lean into portfolios on the longer credit side for that reason.
Yeah, and certainly we would agree that there's those tailwinds. It's the fiscal side, it's the consumer side, it's the business investment side, all pointing in the right direction. And that consumer one about the headwinds from the oil market, energy costs was the kind of thing that was in the way. Obviously hasn't gone away. And our views, oil, it does average $85 a barrel on Brent over the rest of the year. It doesn't seem like a huge headwind to that activity. And also that consumer, obviously that K-shaped economy comes up a lot. But as you rightly mentioned, when we look at the wealth effect and the distribution in the US economy particularly, you look at the top 20% of households, they account for a little bit over 50% of net income, but about 38% of spending. So they are driving it because they have benefited from that rise in prices. Let's start with the macro, and we'll come on to rates in a minute, but obviously as a bond investor, inflation is always top of mind. That's one of the big headwinds to thinking about the performance of fixed income markets. Now, in most markets, we're tracking inflation. It looks like it's peaked in the middle of the year, but we're obviously concerned around the stickiness of that inflation, whether it's from some of these concerns around energy prices or whether it's some of the AI capex story. I mean, what is your take on the direction for inflation? I mean, you could frame it in terms of the US or more broadly.
Yeah, I mean, Kerry, you're absolutely right. Like, I think, we've had a new governor come in, and the reality is, no matter what measure of inflation you use, whether it's PCE, core PCE, CPI, trimmed mean, not trimmed mean, they're all above 2. And I think that's the main issue. When I think about what's expected by the market expects by the end of the year inflation to be somewhere between 3 and 3.5. I think the Fed is closer to the 3.5 side. Closer to 3%. Our view is into the year end, inflation will come in slightly better than what the Fed expects. We're not suggesting that inflation will come in at 2%, which is the Fed's target, but just given where expectations are set based on the summary of economic projections that they put out, we think it's a little bit better. And the reason we think we'll come out in a slightly better place. And the reasons that we think this will happen are sort of as follows. Number one, shelter inflation continues to decline. And we feel shelter inflation is not only consistent with 2% inflation, it's likely to get consistent with even lower than 2% inflation. And any leading indicator of rental inflation, points towards slower month-on-month increases in rents. And so we think that, which is 30% of the basket, continues to sort of decline. We think the worst of the energy crisis is behind us, just as you mentioned, averaging somewhere between 70 and 90 over the course of the rest of the year. And so we view that as a tailwind. We also think the worst of the tariffs is sort of behind us. And when we think about tariffs, obviously the IEEPA ruling, sort of how it plays out, like we know what the IEEPA ruling is, and it results in a reduction in tariffs on China, but how it plays out is also important. But I think big picture there, the way you want to think about it is tariffs got into prices sort of last year, and only if you think the average tariff rate moves further up this year is it going to be a positive inflationary impulse. And since that's highly unlikely, and it's even possible you get a negative impulse next year from tariff effects sort of fading off. Those three would be the main reasons why we think inflation is sort of going to come down. There's one more thing to cite, which is a little bit more market-centric. It's about the sustainability and persistence of inflation. So it is possible that inflation lands right at the Fed's target, or maybe even a handful of basis points higher. We don't think it'll be sustained, and the reason for that is what we see in the labor market. Wage growth continues to sort of slow. Leading indicators point towards stability or a little bit more weakness, and ultimately for a wage price spiral to form, we think wage growth is not strong enough. And so that's why we don't think inflation will be sustained. And that, I think, is really important and central to how central banks will think about whether or not they want to raise rates aggressively.
Yeah, I mean, the labour markets, they remain fairly constrained around the world. You've got unemployment rates that are sort of in the low 4s. Still steady job growth, and I guess in the US context, we've obviously got constraints on the labour supply, but it doesn't feel like people are aggressively demanding higher wages, a little bit over 4% wage growth in the US. So those second round effects of inflation certainly not seen to be kicking in the US context. And I think when we look at Europe, even more different, obviously.
Yeah.
A higher overall level of unemployment, but still low in historical context, and not seeing the wage drivers. And some of the business surveys tracking out of there don't seem very strong on hiring retention. So probably a little bit more downside to growth in Europe relative to other parts of the world. I want to move on to rates. Obviously, kind of touched on your expectations around inflation relative to the Fed there being a little bit below, I guess, what was in the last statement of economic projections. But the question is not just about this year, it's obviously 2027. The markets, as you mentioned, pricing in tightening of policy this year in most places around the world. Us in the Market Insights team, we kind of think about central banks being patient, maybe potentially for a recalibration of rates, a bit of window dressing. But where do you see interest rates moving, I guess, this year? But more importantly, what's the outlook for 2027? That's the real focus. Will it be hiking cycles or cutting cycles into 2027? And how do you see that developing?
Yeah, I think you're right. I mean, if I had to summarize it, I'd say it's easy to talk a hawkish game. It's harder to hike. And so for that reason, I think the market pricing in general on duration is fair. I think, if you have oil prices rising like they are in this sudden reacceleration, I can't see how a central bank would come out and talk dovishly about this. And for that reason, the pricing of 1 to 3 hikes that we're seeing across various markets, whether it's the US, UK, or Europe, that feels fair. Ultimately, however, I feel hiking beyond 1 or 2 times is very hard. And I think that's where the value is in 2027. It's essentially, it's not that growth is reaccelerating or the labor market is reaccelerating. Ultimately, we feel, growth will kind of stay sort of where it is, and the inflation side will only improve. And that'll create space for central banks to cut interest rates. We spoke about growth being good, and you rightly said growth in the US is most likely going to be much stronger than it is in Europe and the UK. And we're seeing issues in UK just like we're seeing in Europe, as you mentioned. The unemployment rate is ticking up. Growth expectations are around 1%, but forward-looking sort of PMI numbers and other sort of survey-related data, both in Europe and UK, doesn't point to the positive side. You see similar problems in Australia. The housing market is no longer as strong as it was. Forward growth is expected to be, 1.5%, 1%. That's most definitely below trend. And so I do think duration, it's a good time to start adding it into portfolios here. In simple terms, if I had a budget of, let's say, between 1 and 10, I'd probably be sitting at 4 or 5, looking to go to 6 or 7. And, if market pricing gets egregious, if the market feels, if the market prices, let's say, 3.5 hikes for the Fed, I think that's a very good opportunity to increase duration materially in portfolios because next year offers much better outcomes.
Yeah, I mean, just on the point there, let's clarify that. So you're thinking duration-wise, you're kind of sitting neutral. So if I say that the ag has a duration of around 6, you're saying 5 to 6 years, and then looking to extend into that as we think about where the growth outlook is going. Certainly, you've just outlined there, potential for rates to fall, inflation not being a challenge. Did you be more specific about where you're taking that duration risk around the world?
Absolutely. The ag is a benchmark of about 6.5, and in terms of the way we think about a risk budget, we could be plus or minus 2 years in duration, so could go all the way to 8.5 or 4.5. We're running about half a year long, which means we're instead of 6.5 at 7. The idea is for this 7 to go towards 8, and we're watching the price of oil as it ticks up. We feel that's when we're going to sort of add. In terms of where specifically to add, I think the growth outcome in Europe and in UK is going to be much weaker than it is in the US. So the first place to add is there. We also think there'll be room to add in countries like Australia. I just don't. As of today, the market pricing seems fair, so we're looking for an opportunity to add there. But when I think about it, when I think about it more sort of broadly, there most definitely will be a bias to own non-US duration in the portfolio versus US duration. I think that's the key theme. And the reasoning for that is market is pricing similar amount of hikes across markets, including in the US, whereas the growth outcome in other countries is likely to be weaker because they sit outside the AI trade and they sit outside, and they're not necessarily energy exporters like the US is. There's one other small thing that I'd want to mention. I think there's a lot of value that's been created in emerging market local rates. And again, you don't want to look at that as a basket as a whole, but there are markets there where the pricing is quite, where bonds are quite cheap. For example, Mexico and Korea, based on current yields, the market expects them to hike 4, if not 5 times. And I think that's the kind of market pricing you want to fade, i.e. you want to buy these bonds because it's unlikely that you'll see 4 hikes. You might see central banks hike a couple of times and talk a hawkish game, which is always talk is cheap. and I think you want to use that as an opportunity to add those markets into your portfolios.
Absolutely. The real yields across the emerging markets are looking much better. I want to come back to that point. It's easy to talk a good game, talk is cheap. We've got a new chair in the Fed, Chair Walsh. He's not so keen on talking. His idea around communication is very different to the prior chair, and he's got a very different reform agenda. So we've got some task force in place to look at how the Fed is operating. You kind of mentioned around going global for duration, underweighting the US, or as it were, to the rest. Is there any of that relating back to any concern around the volatility in fixed income because of the new regime at the Fed and how they're communicating? And does that sort of shift any views you have around the term premium or how we should think about volatility in the longer end of the curve in the US?
I think this is such an interesting question because you're absolutely right. Like, if you were to think about the lack of forward guidance going forward, you would think that that would mean higher term premium in bonds because there's more uncertainty and there's more variables that the market has to price and there's no guidance from the Fed. The reality is, he's come in and said, I'm not, Walsh has established credibility by making a very good case for why he's not in the pocket of, the prevailing government by citing that he's supremely concerned about the 2% inflation goal. And so he's come in hawkish relative to expectations in his speeches. And actually, counterintuitively, without saying much, that's saying a lot. And what that's done is it's actually helped control term premium in the back end. Because the market doesn't perceive him to be as dovish as they previously thought, it's resulted in a flattening of the bond curve. And again, here I would say this is a case of talk is cheap, but very effective. And so, I actually don't think the election of Walsh will necessarily result in increased term premium. We'll have to see how it goes. There's a number of committees that have been formed. We know his biases and we have a sense of the kind of people that he's hired and they're in line with his biases, but it's hard to sort of see today where this will end up until we know the result of what these committees will, on balance sheet, on the way we calculate sort of inflation, where it sort of ends up. As of today, I don't see a reason to, start trading steepness in the portfolio or put on trades that make money because term premium is going up just on his election. I think relative to what we thought about him, he's come across far more credible and reassured the market, and that's kept term premium down.
Fantastic. I mean, that's a lot to take in terms of how we think about the outcome of those task force that'll, I guess, come in closer to the end of the year, how we think about the communication from the Fed, and again, what data we can expect to see if they keep the dot plot, for example. Talked a little about emerging markets already. I want to come back and talk about credit markets more broadly. So, seen good flows into things like investment grade credit this year. Obviously, clients are still wanting to ensure they have good quality bias in their portfolio, given some of that uncertainty out there. There's a bit of a pickup over what you're seeing in government bonds. But there's this question around all the issuance this year. A lot of it's related back to tech and AI, the growing weight that they're now holding in bond indices. Is this affecting or impacting how you're thinking about positioning with this new issuance that's coming through?
Yeah, Kerry, we're seeing a lot of issuance. You're absolutely right. I'm going to throw some numbers at this off the top of my head, based on what I hear from my IG team. But so, the market size in the US is about 7 trillion, and it's growing. The net supply this year is expected to be an increase of roughly 350 billion. So a 5% increase in the size of the market. When we look at the last sort of trailing 12 month demand for these bonds, we think it's roughly 500 billion more than what we would have otherwise estimated based on previous averages, because as you said, we've seen a lot of demand in the market. Yields are high, insurance companies, pension money is flowing into the market to lock in bonds at higher yields. And so the first thing I'd say is supply is big, but demand is bigger. And just given the high level of total yield, we think there's institutional buyers who will more than offset the demand coming in. The second thing to sort of think about is, are we really worried about specifically the hyperscalers, which form a lion's share of the issuance? Are we sort of not buying hyperscaler debt? And the reality is, no, we're actually leaning into buying this debt because ultimately the companies issuing debt today are ones that have low leverage, and they're issuing from a capital intensity perspective, not very elevated levels, i.e. earnings are big enough that the amount of debt they're issuing doesn't currently worry us. The risk is earnings fall, and they fall aggressively relative to expectations. And at any inkling, if we get any inkling of that, that's where you would see us materially de-risk portfolios. So I don't worry about the amount of supply. I worry about the amount of supply relative to earnings, relative to leverage. It doesn't concern me today because earnings are good and leverage is contained. If I start, leverage is ticking up just a bit, but if I start seeing earnings, and it doesn't concern me given the level of growth, but if I start seeing earnings come down, particularly again relative to earnings expectations, that's where I would de-risk.
Yeah, everything does seem to be so hinging on a lot of the very high earnings growth estimates that are still out there. In most cases, we've seen like these earnings estimates be beaten. If anything, there's been an underappreciation for how much earnings growth is actually in these companies. But I guess the question really is it sustainable overall? And I mean, to our mind, we're very much in favor of this whole AI secular theme going through, but just obviously watching these dynamics as they play out.
And Kerry, can I interrupt you there? You said something there that I fully agree with. The earnings, everything does hinge in some way or the other on earnings growth and on stock market momentum as a consequence of earnings growth. But I think that's why you own duration in portfolios. And that's why you look through the oil crisis and the move up in yields, because ultimately a 20% drop in the stock market should bode well for duration if you believe that, like I do, that medium term inflation's not going from 2.5 to 4.5, but going from 2.5, 3 back to 2. That's when bonds become a diversifier, and I think the market sees that. And on days where earnings are not good and oil is not as much of an issue, I see that negative correlation between bonds and stocks, and that's why you own duration. That's why we're that 0.5 years long rather than underweight.
Absolutely, if that next shock results in a growth shock rather than the inflation shock we experienced the first time round. Outside of credit, outside of investment grade or high yield, anything else in the bond market that's taking your interest at the moment in terms of positioning to pick up extra income?
Yeah, I mean, I think generally we like emerging markets and credit, and we also like some securitized bonds. We think the U.S. consumer, particularly upper quartile, remains pretty stable. Their balance sheets or the amount of disposable income that goes towards paying interest payments, even now, is not elevated relative to its sort of own history, long term, 20-25 year history. And consumption looks good. So I think there's some value in securitized. You can get paid, instead of the 75 basis points of extra compensation that you get paid in IG credit, you might get 150 for single A, double A, even triple A debt in some cases. And I think you want to add those bonds in small amounts in your portfolios. And so that's another place we're adding. And the last thing I'd say is, I think the oil crisis will create opportunities in FX, which should be bought. And so we do like EM local FX. We've tempered our positioning for now, but I think that's an obvious add, given the inflation dynamic in our view is not too bad globally, and there's some value there that we could lean into.
Fantastic. Arjun, thank you again for taking us around the current thinking of the bond market positioning as well as your own macro views on how things are shaping up. Thanks for listening. If you enjoyed this podcast, please share with your colleagues or consider subscribing for future episodes. Arjun, again, thank you.
Thanks, Kerry.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.